Yes, believe it or not, I was like you. I was sitting in that chair 20 years ago. It's hard to believe, but I graduated in 98. And I was just interviewed by some of your colleagues for one of the newsletters. And the last question they asked me, they said, "Well, what was the best thing that happened when you were at Ivey?" And I said, it's the friendships that I made. I stay in touch with the people that I go to school with. And you'll develop friendships here that will last a lifetime. I know it sounds like a cliche, but it's really true. So enjoy your time here. It is a finite amount of time, and then you'll be on to the real world shortly. But anyway, I'll talk to tonight. I'm going to talk to you about value investing, and it's one of the passions that Professor George and I share, and many of you do too. So I'm hopeful that you can get something out of it tonight. My focus principally is in the Canadian equity space, although I always like to tell this small little story. How did I get into investing? And when I was a young person and delivering newspapers, I was a saver. And if you're an investor, you're inherently a saver because you're deferring, consumption now for a return, a larger return in the future. So my mother was an economist and an investor herself. And so in the day when I started putting small amounts of money in the market, it was actually in bonds, believe it or not, when bonds in Ontario, the Ontario government had bonds that were yielding strip coupons, were yielding 14, 15%. And those were epic returns. I just wish I had more money I could have put into them. But I migrated to equities. And the other little story that I tell you is my first stock that I bought was Bank of Montreal. And ultimately, when I bought my first house 10 years ago, it helped pay for a good chunk of that. So, the power of compounding over the long term is, I think, just an incredible thing, and something that you just take advantage of it now. The younger you are, the better it is. Okay, so we're going to talk about value investing. Let me just make sure here. Oh, we just skipped one slide. I'll just give you a little bit of the background on Foyston, Gordon, and Payne. Maybe this is a little self-serving, but it's the spiel on the firm. So our firm started in 1980 by three gentlemen, and on the premise of providing, a boutique, bespoke investments for Canadian clients. And so we're approximately $13.3 billion today. We manage mostly Canadian equities, but we have a fair amount in global and also in fixed income, and have some sort of niche products as well, such as emerging markets and preferred share funds. But we essentially have three teams: a Canadian team, a global team, and a fixed income team. And I work on the Canadian team, as the young lady was saying earlier. We have in our firm, we have approximately 55 employees, and we have a variety of shareholders. It's a partnership model. Our main shareholder is Affiliated Managers Group, ticker on the New York Stock Exchange, AMG. And AMG, without talking a lot about them, they make investments in boutiques such as ourselves, provide liquidity for the partners, and help with generational transfer. And maybe another day I'll talk about the business of investing, but they're a really great partner. Otherwise, we have 23 employee shareholders, and I'm one of the shareholders. And so not only am I investing in companies, but I'm investing in our own firm. And so I put my money where my mouth is. And the other thing too, which I tell all of our clients, is I invest in my own products. So I don't have any discretionary holdings. I only own our own funds, which may sound, a bit bizarro. I actually invest exactly in what I tell my clients. And when you're looking to talk to a fund company or maybe join them, you should always ask that question and say, well, how much do you actually have in your own funds? Do you, or do you have some stocks on the side? And I think I'm telling you a little secret of the business, but you want to know, you want to work with a firm where they believe in what they do and they eat their own cuisine. Okay, so let's first set the stage and just talk about the value spectrum, I call it. I'll be honest, I've seen other slides like this, the value church, what is value investing? And so I think philosophically, value investing obviously started with Ben Graham. And that, Mr. Graham was really, at that time when he was doing investing, he was really looking at companies on an asset value basis. And in some cases, these were companies that were blowing up and distressed. So that's sort of the origins of value investing is really looking at asset value. Some of you may have heard of nets, basically looking that the company's assets are trading meaningfully more than what the stock price is trading, and that you buy that and you're going to realize value somehow. Over time, I think there's this category called traditional value. And traditional value really is looking at any company and not just at its assets, but its franchise value. And its franchise value is the academic term, and I would say the more practical term is a company that has earnings and can grow its earnings over time. The assets are important, but the franchise value, I know based on some of the reports that I've read, the franchise value might be greater than the asset value or less. But generally speaking, these companies would have franchise values greater than their asset values. But it would still be important to have assets. And I'm just going to give you one very quick, simple example. A grocery store called Loblaws. We've just gone through this period of interest rates going down, and REITs have been great investment vehicles. Now, traditionally, we haven't invested a lot in REITs, but we believe in real estate. And so when we made our investment case in Loblaws, we always knew that they had a lot of unencumbered real estate and that it was worth something. And so, we'd say to our clients, we think there's probably $10 to $15 of real estate value here. At the worst times, the Loblaws, the stock was trading around $30. So you weren't buying the grocery business for a lot. And as it turned out, we were validated on some of that value when shoppers ultimately decided to buy. I just gave the answer away. I was just going to ask you the question. I was going to say, who did Loblaws buy? Shoppers. So Loblaws bought Shoppers Drug Mart. And before they did that, they created Choice Property REIT. So they created the REIT and spun it out. And so you could do the valuation. But the bottom line is, the real estate's important, but the franchise is probably more important. Because that's called traditional value. And as I said, it could be any business in any sector, CapEx light, CapEx intensive, doesn't matter. And then there's the more towards the Buffett side. And I sort of say this broadly, although even Buffett's changed quite a bit. And I'm not the Buffett expert, but Buffett's always viewed that he wants to buy recurring businesses that are very light on capital, but have great brands or great moats. Whether it's buying a beer company or a Coca-Cola, that's a great brand. Arguably, maybe the brands come down a little bit in value over time, given some of the changing tastes for soft drinks and things like that. But very, very understandable business. See's Candy or Say's, I don't know how you pronounce it, but apparently he paid a couple $1 million, and that thing is it's paid itself so many times over. A candy company, a confectionery company, but these are all very capital light, high free cash flow businesses. He's not a big fan of cyclicals. He doesn't own he has actually owned in the past some energy companies, but generally he shies away from sort of cyclical businesses. So that's what I would call the spectrum of quality. And I'm going to be a little bit controversial and maybe even just float this idea, even though I'm not fully a subscriber to it. With companies like Amazon and the digital, like in the past 10 years, we've seen the impact of digital companies. And even though these digital companies may not be traditional value companies in the sense I've heard, and I do listen to other investors, one investor articulate Netflix as a value investment, which I find a little difficult to say it is because it doesn't have a strong earnings focus, but it is building an incredible franchise. And I'm sure, how many people here subscribe to Netflix, just to Yeah, I mean, it's just unbelievable. And how many here would be willing to pay $1 more or $2 more, $3 more? So, so Netflix could generate an earnings if they just sort of really put the screws to us. And all of us here are subscribed. I have it as well. So, but I'm not going to get into that tonight, but I'm going to be reflective that digital business models do have an impact on value investing in some cases, in ways that sometimes we don't appreciate. I'm going to talk a little bit about the Foyston value approach. So this is one of our client slides, and it's pretty typical. You talk about quality and value. So what's our definition of quality? I mean, I always sort of joke with clients. I say, okay, well, who's in the business of buying crappy companies and non-quality companies? I mean, it's sort of like it's a catch-all term. So I'll try to be a little more specific with you. What do we view as a quality company? Well, a quality company, first and foremost, is a company you understand. And this goes back to this notion of your circle of competence. I mean, there's hundreds and hundreds and hundreds of companies that you can invest in. And I, for a second, don't pretend to be an expert in all of them. I mean, my background is in telecom, so I know the telecom space reasonably well. I've done a lot of work with banks, and I understand, at a high level, the various ways that banks make money. So I have some degree of comfort. That's where my own inherent biases are when it comes to investing. I'm not an expert in energy. I'm not an expert in utilities. So I think as an investor, you need to know where you're comfortable and where you're not comfortable, and don't try to BS yourself and saying, "Oh, I understand everything about this business." I doubt it. I think you do need to be as a successful investor. You do need to have some degree of specialization. You have to understand something a little bit better than someone else. And the other thing too is there's a behavioral aspect of when you're doing stock selection, which I'll talk a little bit on the value side. So companies, first and foremost, that we understand, Loblaws, I understand how the grocery store business works. There's product that's bought, it's usually consumed fairly quickly each week. There's tonnage, there's price inflation, sorry about that, and very low margins. And the industry dynamics are based on the square footage growth. In other words, if square footage growth of stores goes up too quickly, then you're diluting your customer base amongst those stores. So I have a sense on the economics. There's obviously a real estate component as well. Track record and history. This is another thing too. I mean, I'm not sure. Do you guys look at analyst reports? Obviously they have Bloomberg and access to all that sort of stuff, Capital IQ. So you're researching a company, and you get the TD report or the BMO report. And I just find it comical that an analyst do these forecasting and saying, okay, from 2017 to 2025, we're going to have earnings growth of this, and Well, they won't spend any time sort of saying, well, what did the company do in the past 10 years? And, how much you're willing to pay for growth, that's up to you. So sometimes, the best way to, you try to predict the future, but sometimes the best thing is just to look at the past cycle and say, okay, what has it done? Okay, and maybe it's a bit higher, maybe a bit lower, but if I didn't know anything else, what would I be prepared to pay for the existing track record? But the point is, you want to see the track record. How well has this company done? I'll give you an example. So given we're agnostic and we invest pretty much anywhere in the Canadian market space because the market is fairly narrow, I'll just use a material company. So two material companies. So you got Barrick and Teck. Now, how many people have heard of either one of those companies? Okay, so most have heard about it. Okay, so let's just talk very quickly. Teck is a base materials company. They produce copper, metallurgical coal, zinc, and copper, and they've had at periods of time a bit of gold. Barrick is really a gold company, but they do have some copper based on an acquisition that they did in a while. If you take a look even at the last 5 years and see which company's been profitable, you'll notice that Barrick's not a very profitable company. It generally doesn't make money, and there's a lot of reasons why, whereas Teck does. So all things being equal, as an investor, if you're going to look at a company and say, okay, what's the likelihood of this company being a going concern? You're going to want to go with a company, hopefully, that is able to generate a GAAP or IFRS profits. And, there's obviously subtleties on the quality of earnings, but you want something that's making money. I mean, I'll never forget my accounting prophet, Ivey. I don't even know. I won't say his name, but he always say, Bryan, how does this company make money? I mean, it was sort of like he was like Scrooge McDuck, and trying to be a money grabber, It's like, well, that's a good question. How do they make money? So, with this particular case with Teck and with Barrick, Barrick is trying to get a gram of gold out of a ton of rock. Okay, for any of you that are, sort of doing this, just think about that for a second, okay? A little microscopic little fleck of gold in a ton of rock. Boy, that's going to be costly, versus the copper. You can sort of see it in the ground, or even more easily metallurgical coal. I mean, it's a base material. It's easier to discover. So there's a lot of implications on that. So anyway, long story short, track record is very important. Balance sheet strength. So when you invest in a company, you have to be very, very, very mindful of the debt on the company's balance sheet. I mean, in a perfect world, no debt is really what you want. I mean, that's generally, if a company has no debt and they can grow their earnings organically, that is really nirvana. As soon as a company has debt, then you have to ask yourself, well, what kind of debt is it? Is it fixed or is it variable? What's the duration of the debt? What's the term of the debt? What's the interest rate? So, and you got to be really concerned about companies that do M&A and all of a sudden come to you and to the investor, and you say, oh, we just bought this company and we paid, blah, 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 and we're going to have to put on all this debt. And, we got this massive bridge loan, we'll term it out, da, 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 da. Well, if the EBITDA, which is a bizarro term, goes down, and debt stays up here, then you got problems as an equity shareholder. So you really want to ideally own companies that have strong balance sheets. Balance sheet optionality, net cash is preferential. Management. Now, this is a tough one, but you want to own companies where the management is candid and don't bullshit and don't try to do a snow job. And your jobs as analyst is to not fall in love with so-and-so about all this big plan and blah, 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 blah. Your job is really to compare what they say, understand their strategy, and then look at it from a financial perspective. You want companies where you understand what the management team, how the management team is going to create value, okay? And some management teams, they don't know, and they change their strategy every year, and you know what? That's not good. You don't want a company that's flip-flopping all the time. Last but not least, and this is all sort of MBA 101, competitive advantage. So what is it that the company does that gives them an advantage? Like, why do they exist? I mean, what do they do that's special? So, Porter type stuff. If it's a commodity company, they better be a low cost producer, right? Like a low cost producer. Long life reserves, if it's maybe it's a widget or something in particular. But one thing's for sure, with equity investing, especially in value investing, if Amazon or Google, Amazon, or rather Google and Facebook have decimated the media business. Like they've killed newspapers because they just suck in advertising dollars and there's nothing you can do about it. So, now here's another example. Whole Foods got bought by Amazon. So, internally in our teams, we spend tons of time talking about this. Like what's Loblaws going to do, and are they going to do the right thing, and da 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 da. So, you got to ensure that your companies have a competitive advantage. Okay, now on the value side, it's great to have a great company, but if you're paying full freight or full price, you're not really going to get a great investment return. I use a very simple analogy with clients. It's like, okay, I don't know, maybe some of you still do grocery shop, buy bananas. Bananas, if you were buying bananas at $1 a pound, that's not really a deal. 89 cents. Okay, maybe that's sort of the going rate. If you can get them for 59 cents, that's like, wow, that's a good deal. Let's buy a dozen. Let's buy 2 dozen. You load up. So it's the same thing in buying companies, is you want to buy companies when they're on sale. And I'll tell you something, some companies don't come on sale very often. So you got to be patient. And that's going to be one thing I'm going to underline at the end of the presentation is, as an investor, you have to be patient because there might be one time in 10 years, maybe 2 times, maybe 3 times. Better to be patient and wait when it really comes on sale than to just say, oh, I'm just going to go out and buy it. And, the multiple will take care of itself. The academic is, if you buy a company with a PE of 10 times versus a PE of 20 times, the expected return of the PE of 10 times is obviously a 10% return, right? If the PE is 20 times, it's a 5% expected return. So your going in total return is going to be much lower at a high valuation stock. So valuation, you want to look at earnings, you want to look at book value, and you want to make sure you're not paying too much. And then in terms of what you're willing to pay for a company, look at its relative valuation, look at its historical valuation. And the other thing too is we talk about PE, but I am a big believer in EV to EBIT, right, to normalize for the capital structure. So I think you should obviously take that into consideration. Now, in terms of looking for ideas, obviously you can screen for quality or you can screen for value, right? If you're going to screen for quality, it's basically this burgundy notion of the dream team list, right? Where you're going to try to identify the highest quality companies in advance, the ones that are candidates, and then wait for them to come on sale. The other approach is obviously screening for value. And this is, I'm sure you'll do this for some of your exercises where you'll say, okay, I'm going to look for low PE, low price sales, low price to book, those kinds of things, and see what comes up on the screen, and then say, okay, is this company any good? Is Aurora DevTech any good? Is Corby's any good? Is Morguard any good? You can do both approaches. In the Canadian space, there's not that many companies in Canada, so we generally sort of know the ones that we want to own. We have our own working list. But you have, what I would suggest is you have to decide what you're comfortable owning and understanding the nature of those companies. So I don't think that either approach is one is right or one is wrong. You have to decide, but don't just buy anything just because it comes out with a statistically cheap PE right off the bat. I think the days of a little bit of buying PE stocks on a single factor is not necessarily going to yield kind of the results you need for the long term. I think you got to do more than that. Thank you so much. Okay, in terms of the company analysis, if I can simplify it, I think there's three things you need to look at. Operational performance. At the end of the day, you want to own a company that is a good operator, right? So how are they doing in sales? What are their margins like? You look at key performance indicators. If it's a retail store, you want to look at same-store sales. Are they doing, that is the lifeblood of a store, is same-store sales, right? You want same-store sales going up all the time. Simple as that. So, when you look at a company like Canadian Tire versus Dollarama, Dollarama's got sort of mid-single digit same-store sales growth. Canadian Tire is sort of low single digits growth. But Dollarama's trading at, call it 17 to 20 times or somewhere in that ballpark, whereas Canadian Tire's trading at 14 times. So you have to say to yourself, okay, well, what's the trade-off that I'm willing to make? In our case, between that trade-off, we took Canadian Tire. We think it's better value. It's a lower PE and almost sort of 2/3 of the growth that you would get with the Dollarama. On the financial performance, clearly everything should be on a per share basis, first and foremost. That's very important. And, for us, earnings is really, really critical. You want to look at debt loads. As I said, for less debt than more. Free cash flow. This is an abused term in the industry, but I would say a simple one when you're doing your financials is look cash flow from operations relative to net income. Cash flow from operations in general should always be higher than net income. If it's the reverse, it's a Ponzi scheme. Investing returns. So, there's a book called The Outsiders, not the one that we read in high school for some of those that know the Hinton book. No, this is the one by Thorndike. And if you haven't read it, I suggest you read it. It's a quick read. I think it's a great book. And what Thorndike tries to articulate is that really great companies that have good management, they're good operators, but they're great investors as well. So they're good capital allocators, which is a fancy term for saying they know how to invest in companies or in divisions. They know how to sell divisions. They know when to buy back their own shares. They know when to do a dividend. They know when, they're just good capital allocators. Self-financing. In this day and age of incredibly low interest rates, companies are being offered money on a silver platter from BMO, Royal Bank, CIBC, blah, blah, blah. And the banker, and some of you may become investment bankers, I have nothing against them, but their motivation is really simple. It's like, you know what? Go and buy this company. It's going to be great. And we'll give you all the money you need to do it. Don't worry. The market will love it. And we'll sell you some shares and blah, blah, blah. And so then I get a phone call from someone at TD and says, Bryan, the company's doing this bought deal. Do you want to buy some shares? I'm going, what are they buying? I'm like, oh my God. And so I usually bulk. I'm not very good. I'm very stingy. I don't like writing checks very often. But you want companies that frankly can self-finance. That means they don't have to go to any of the Canadian banks. They're just profitable. They have retained earnings, and they can take the money that they earn and reinvest in the business. That's really what it should be. Management quality and the board quality, execution by management team. So here's a very small example. I don't know if any of you tracked the wireless business. Rogers, this past quarter, they had an execution screw up with their ERP system. There was a whole bunch of price wars with Freedom and a whole bunch of things. They lost 35,000 subscribers. Joe Natale, who's the CEO there, used to work at TELUS, great guy, but that was a flub. That's what I call execution issue, when something happens. Another execution issue that happens long after the fact is when a CEO says, you know what, all that money we thought we were going to use in that project, we just took $1 billion impairment charge. And oh, by the way, it's non-cash. So it's really no impact to you, Mr. Shareholder or Mrs. Shareholder. I'm like, give me a break. When a company does an impairment charge, that means something happened that wasn't good. And they try to blow it off, but you should always, any financial statements you look for impairment charges. If there's lots of impairment charges and they're big numbers, you should be worried. Insider ownership, disclosure, governance, boards. Boards are hard to evaluate, but you want boards that are good actors. Okay, so I'm going to give you an example of a company that we currently own. As I said, it's in our small cap fund. This is a company I know near and dear to my heart. I describe this company as an example. I'm not in love with this company. We could sell this company. We currently own it. This company is a Canadian company called Calian. I don't know, has anyone heard of this company? Okay. So when you go to invest, you can invest in the Royal Bank of Canada. Everyone's heard of Royal Bank, right? And it's a good company, don't get me wrong. Very, very well-run company. But as an individual investor, and it's your own dollars, you want to have an edge. So you want to find companies that maybe aren't quite as well known by the world, okay? And so this is a company that just happened to be in my hometown of Canada, Ontario, which is now Ottawa. This is how I know about it. And I was curious about them. So I learned what they did. And my mom actually interviewed them a long time ago. And that's sort of how I picked up on it. So this company is a tech company, and it does really two things. It manufactures components and parts for the satellite business. It creates the base stations for the Inmarsat constellation. So it does a whole bunch of stuff on the satellite side. And it's got and they make very specialized equipment, test equipment for cell phones and things like that, specialized manufacturing. The other side of the business is a consulting business. And some of you may have heard of CGI or Accenture or Deloitte's. Consulting businesses are different businesses. They're where a company hires a person to do something, and they're hired on an engagement. The model's fairly simple. They maybe pay that person $150,000. They build them out for $300,000. They do some coding. They redesign a process. Doesn't matter. I'm just saying that's what they do. So it turns out that Calian is very big in training, IT, and healthcare. So they do a lot of work for D&D and the government in providing doctors who aren't necessarily part of the military. So if a doctor wants to work for the military but doesn't want to go through the whole process, they work for Calian, and the Calian's a great employer for that. And you can see that the staff levels are quite different, right? So one's a very small, niche division manufacturer, another one's got people all around the world. Okay, I'm just throwing this up here. You're not possibly going to be able to analyze it, but this is just the segmented profitability of the two divisions. So you can see the revenue, you can see the gross profit, the operating profit, and I put the margins there. And the operating profit, if you just look in the middle here, which is right around here, I mean, you can just sort of roughly see 10 million, 10.6, 9.5. Systems engineering's last year, 12.4 million. The business and technology is a little more volatile. You can see it's gone from 10.8 down to 5.5, back to 11.8. So nominally, one looks like it's a little more volatile than the other. And that's important to know as an investor, because when margins are depressed, and we're value investors, we're mean reverting, i.e. we believe things move back to the average. So if a division's underperforming, well, it's probably going to get better. I mean, that's sort of a fundamental crux of value investing. And you need to use that when you make your investment case to say, okay, guys are not doing so well right now. This division's a little underperforming. I think it can get better. So financial history. So just to give you a sense of this company, so here's the revenue from 2001 to 2017. And it's been a pretty nice trajectory. And value investors, my partner John always says to me, he says, Bryan, how much growth do you really want to pay for? Like we're generally not growthy people, but we like to have a bit of growth. I mean, you have to have some growth. If you're in X decline, unless it's the cigarette business where demand is going down, but the price just keeps going up, you can make a case for that. But if it's the newspaper business and it's in terminal decline, that's a proverbial falling knife. So you want generally companies that are growing. Now, I've just shown on earnings per share on the other side there. You can see they had one bad year. I'm sure they took a charge there. But in general, it's been a little bit lumpy. It's a little cyclical, but it's generally been growing earnings on a per share basis. That's sort of what you want. We believe fundamentally, as Warren Buffett says, the market might be, I forget the exact quote, but he sort of says like the market might be, it might be a popularity contest in the short term, but it's a weighing machine in the long term. We believe that earnings over time, it's the weighing machine. That's what drives the value up. If you apply a multiple and say, okay, this company should have a 10 times multiple and the earnings go from $1.80 to $2, and the stock should go from $18 to $20. That's sort of the very simple math. And that's how we view investing. Now, you can buy growth. You can buy a bunch of companies, you can take on a bunch of debt. So just on one thing here, just on the left side, this is the share count. You can't really see it, or at least I can't quite see it, but they started out with about 10 million shares. They're now at 8 million shares. This is a company that's been around for 35 years. Share count's gone down. As an investor, a minority investor, I'm like, great. These guys are not diluting the hell out of my position. In fact, they're buying back shares. Like, okay, that's sort of good news. And then the second thing on the other side, you can see, now I should have probably done this a little differently. I should have used retained earnings, but I put equity, and then you can see debt. And by the way, that's net debt, i.e. it's a negative number, i.e. cash. Just like I saw you say cash is king. So this is a company that's managed to grow their earnings, translate that into book value growth through retained earnings, high quality retention. And they haven't used any debt. I'm like, holy smokes, this is a great company. A company that can grow with no debt. Now, I haven't showed you ROE, and the ROE, trust me, is reasonably good. Sort of call it mid-teens, sometimes a little bit lower, sometimes a bit higher. But totally acceptable for me. I'm like, now, I talked about management effectiveness, so how can you measure that? So I think one thing you can do is you can always look at margins, right? Margins sort of are the, how close are they? Now, margins can be impacted by a bunch of things. Your business mix can change margins, right? So just the mix concept. And then we have two divisions here, so that's going to have an impact. And obviously, I'm showing you consolidated. But you can see that, so Larry O'Brien, he had a great run. He sort of got the net income. Now, the gross margins at the top, you can see he had some improvement. The gross margins in this business sort of peak at 20%, trough at, call it 16%. So that's sort of, unless the mix changes radically, it's not going to change that so much. So when you're making your thesis and you're sort of trying to anticipate what earnings might be, you can sort of say, well, I don't think gross margins are going to be that much better. But you can see at the end of this guy, Ray Basler, this is the last, sort of second last CEO. You can see that he did a great job, up to 2009, and then margins just sort of went down. And he was having problems growing the business. And expenses were going up, and things were starting to stall. The company was still profitable, but the company, towards the end of his tenure, started issuing for the first time earnings warnings. Like, that's just something you just sort of go, oh. And we'd sort of felt like the business could be doing better. And so not surprisingly, the stock price came down quite a bit. Now, fundamentally, there's another factor, which is I told you about this consulting business. So they do $80 million with D&D, Department of National Defense, every year, and their contract was coming up. And so that contract was coming up for renewal, and that's a big chunk of change. So, they have to invest in that to renew the contract, and the stock and sentiment on the stock was coming down as well. So there's a whole bunch of little factors, some impacting this, some not impacting this, but the company's valuation came down. Then this new guy, Kevin Ford, who we met. And by the way, whenever a company changes CEO, whenever that happens, make sure you're very attuned and watching closely, because sometimes you can get someone that was a good CEO, and sometimes you can get a greater CEO. You can also get someone that's worse. You got to be very, very mindful of what's going on, because one person can make a big difference. So it's important for you to understand, who is that CEO? Is that individual capable? So Kevin Ford was an insider, but he was a fairly new insider. He came from IBM 2 years before he got sort of the top job. And the other thing too is, when you look at a company very closely like we do, you sort of watch where the senior people are moving around. Like, I hate to say it, it's almost like people are baseball fans or leaf trades, things like this. You sort of, is anyone an Ottawa Senators fan by any chance? Oh, we have one. Fantastic. So when the Senators picked up, I'm not a big hockey fan, but when the Leafs traded like 7 players, including Phaneuf, to Ottawa, I go, what? Dude, like, this guy's such a dumb. Phaneuf turned out to play reasonably well for Ottawa. Okay, maybe not great, but anyway, doesn't matter. It's a terrible analogy. But the point is that maybe your fans of rugby or soccer, and you see trades happening, and you say, oh, that was a great trade, or that's a crappy trade. Anyway, just be attuned at the senior management, because these are the folks that are going to change things. So Kevin Ford, we hadn't really met him, but we started talking to him quite a bit. And he said, oh, what are you going to focus on, Kevin? And you interview him. I said, well, we need to improve our profitability. We need to start growing the business again. We haven't grown the business. Okay, that sounds interesting. Don't know if you're going to do it. How are you going to do it? Well, I got this IT division, and I think we can leverage it. And, that business we have with D&D, I think we can get Suncor to buy some of that service. And so you listen to people, and you try to see if they can do it. And so sure enough, Kevin managed to do it. Now, I'm going to come back to a few things in a second, but really quickly, here's just an executive comp chart. In this day and age, when we look at executive comp and CDAR under the management proxy, some of them are so damn complicated. I mean, like, there's numbers everywhere, and you go, wow. This is simple. He's got a salary. He gets some shares. They do have some options. You can see his annual incentive plan. That's it. It's pretty simple. You can calculate the percentage of their comp and total net income, and you can do some math to see how much their comp has gone up and relative to what the market's done. Anyway, something you should look at. Here's Calian since 2006, a courtesy of Google. So you can see that it's done really, really well. This is in a totally, again, you guys don't even know this company, and it's done great. So investing doesn't necessarily mean you have to own the flashiest thing or the thing that is, everyone's talking about. Okay, who here owns a cannabis stock? Oh, we've got 1, 2. Geez, you're not going to like my next slide. But anyway, or my anyway, don't write negative reviews. So here's Calian from 2013 to 2018. So I've painted this picture of a reasonably good company, not perfect, but reasonably good. And then if you look here, 2014, 15, 16, underperforming the TSX. Oh, interesting. And Ray Basler, remember I was telling you he's having some problems? He eventually leaves in 2015. Oh, Kevin Ford comes on. Oh, interesting. So there was an opportunity to buy this company, and any one of you could have called the CFO. It's this kind of company. It's not that big. I forget the exact market cap. Well, we actually have the share counts, 8 million shares. So, so we're talking $200 million, right? It's not that big a company. But you could call this company up. You could. Not just big institutional investor. You could call them up and talk to them. And they'd give you everything you need to know. Okay, valuation matters. So here's Calian. In 2016, you could have paid 11 times PE. Company with no debt. Actually, net cash. I mean, with a decent mid-teen ROE, earnings growth that's been a little lumpy, but generally going up. Some reasonable prospects. I'm like, in this day and age, what's the TSX trading? Who knows what the TSX is trading at right now? Trailing. Come on, there's got to be one person in here. Take a guess. Yeah, 20 times, 17, 18, 20 times. So here's a company that's trading at half, I'm being generous maybe, half of the market with an ROE that I'm sure is better than the market. I mean, what's not to like? And you can pay 11 times. Well, guess what? As Kevin Ford works his magic and starts growing earnings, P re-rates up to 15 times. And the earnings go up. So at the trough, the earnings were around $1.30. They just did $2 this last fiscal year. Okay, so $16 stock to $32 stock in, call it 2 years. Beat the market. Right? That's a good return on your investment, right? If you bought it at $16, if you had the foresight to say, oh, it doesn't look great, but there's not a lot of negative, a lot of negatives have been baked in. That's interesting. Come on, that's exciting. I get excited about stuff like this. So what's some of my thoughts? So identify a high quality business that doesn't need to be public. Really great companies that don't need to be public. What I mean by that is they don't need to raise capital. They don't need to continually ask for shareholders to write checks. They're just companies that can go and do their own thing and they're self-sufficient. You want companies like that, especially ones that don't need any debt. That is nirvana. This is a company that you'd be willing to buy yourself 100% if you could afford it at the right price. Second thing is individual investors can gain an edge. So Professor George has spoken about the inefficiencies in the marketplace and how small cap stocks can offer opportunities that you can't get in large cap. Like, how are you going to compete against a gazillion other people in the marketplace? Well, one way you can compete is looking at smaller companies that aren't necessarily on the radar, right? You can do the screens to sort of identify potentially some interesting companies, and then you got to do your homework, right? Okay, when investing, be patient to buy at the right price. This is so important. If you bought Calian today at 15 times earnings, could you do it? If you had a gun to your head, yeah, probably. Is it a bad company? No. It's 15 times PE high. Yeah, it's a little on the high side. Still cheaper than the market though, but it's a smaller cap company, so it probably shouldn't trade quite at parity. So you've got to wait for the time when the price comes on. I'll give you another quick example. This one's a little more well known. SNC-Lavalin. Anyone own SNC-Lavalin? Bueller? Oh, Mr. Athanasios. So so you know very well some of the issues at the company. There's a guy that was accepting kickbacks. Ben Isaiah, I think it was his name. We were reading about this in the paper. This was in, I think, 2015. And John and I, my partner, are going, oh gosh, this does not sound good. SNC-Lavalin at the time trading $56. Our analyst Brandon said, good quality company. This was before full disclosure. Half the business is in engineering. Other half of the business is in infrastructure assets. So the 407, they own 16% of the 407. If any of you just want to have fun looking at probably one of the most profitable businesses in Canada, if not in North America, if not the world, just go take a look at the 407 financials on Bloomberg, and you'll go, holy shit, I've never seen a company make so much money and have such high margins. It's unbelievable. Sorry for the little expletive there. So SNC owns 16% of it, along with CPPIB, along with Acciona, which is a Spanish infrastructure company. So that's worth something. And then they own some other assets in Alberta. So at the time, we thought that those assets were worth probably around $20. Anyway, fast forward a month since that reporting of that guy taking kickbacks, CEO Du Aim resigns because it's clear that more has happened under his watch. The board fires him. Stock goes from 56 to $37, $38 in a day. We'd already done our research. We figured the fair value was probably best case scenario $50. We probably thought there was 20 to 25 on the infrastructure, and we thought the engineering company, once it's fixed, could be worth 20 to 25. So from 38 to 50, we thought it was a fair risk reward. It could go lower. We bought 4 million shares pre the open, just like that, because nobody wanted to own this thing. So we bought it. We were very contrarian. And, so how did our thesis play out? So the stock's now trading around $56. We think it's maybe worth 60 to 65. So it's getting fairly priced. The infrastructure assets that we thought were worth 20 to 25 are probably worth more like 30 right now. So, and the engineering business that we thought would be worth 20 to 25, it's taking a little longer to realize that value. So we were a little bit wrong there, but we were right on the infrastructure assets. And we waited until there was incredibly bad news before we made the plunge. We'd done all our homework. So if we bought it at 56 and then owned it, we wouldn't have had zero return. So last but not least, be realistic on what you know and what you don't know. And don't try to be an expert on everything, and be a skeptic, because the capital markets business, it's all about, frankly, taking money from one hand and putting it into the other. You want to buy stocks, you want to own the companies, you want to be good capitalists, but at the end of the day, there's an investment banker that wants to sell you some shares, there's a CEO that wants to sell you shares, the CEO wants to make a massive company so he can get paid $20 or $30 million. This is a business of that you have to be incredibly skeptical about in order to be, I think, have a fair shot. If you're not skeptical and you just buy everything that everyone tells you, you're not going to last, because it's too Darwinian. Career advice. Okay. Someone's going to get mad at me on that cannabis, if you can see my reference there. Okay, I'm not trying to be Debbie Downer here. Some of you I know have aspirations to go on the buy side. These jobs are extremely rare. I can't tell you how our team, our Canadian equity team, we've worked together for a decade. The last person we hired was approximately 5 years ago. And, will we add someone to the team at some point? Probably, but very, very, very rare. There's just not a lot of these jobs. So if you want to get into the buy side, be very open-minded about getting into the financial world, and then you can move around. Don't get into this business if you don't like numbers. If you don't like numbers, you shouldn't be in this business. If you think reading is a waste of time, you shouldn't be in this business. If you haven't owned a stock or a bond personally, you shouldn't be in this business. If you love jumping on the latest fad, you shouldn't be in this business. If you don't consider this job the most incredible job opportunity in the world, don't get in this business. If you think Bitcoin and cannabis are exciting investment opportunities, definitely don't send an application to Foyston. If you think that you can pass those hurdles and you're a curious person, you're inherently skeptical, you like doing analysis, maybe not super deep analysis, I'm not talking like huge calculus, but you like to contemplate things but translate that into math. If you can actually write something that's compelling, 1-pager, 2-pager, saying, this is why we should invest in this company. If you've been doing this already, i.e. you've got a portfolio, you're not a heavy churner, you've got some names, and you can say, yeah, this is why I own these companies, and you've been doing it for some time, then I think there might be a place for you in the buy side. The other thing is you've got to be incredibly humble and at the same time not care what others say. And that's called an independent viewpoint, right? Because in our job, especially in the value school, you are sometimes taking an investment in something and everyone's going, what are you doing that for? Like when we bought SNC, we had every Quebec client call us up and say, we're going to fire you guys. What, are you nuts? Why are you buying this POS? These guys are crooks, blah, blah, blah. And we had to defend. And defending is tiring. This is like it wears on you. So sometimes you have to have an incredibly thick skin, because what we're trying to arbitrage as value investors is from pessimism to optimism. And sometimes that takes time.
I know you've held Dorel for some time now, and
Sadly, yes.
He's not doing very well today. Was that down about a couple of bucks? So what do you think? You think like bad strategies, bad management, could it be a value trap?
Oh, well, all I can say is you have a portfolio of 30 to 35 names and you don't get everyone right. And Dorel, for those of you that don't know, Dorel is a company based out of Quebec. They have 3 businesses. They make like car seats and kids trikes and things like that. They have a business where they sell bicycles. 2 big brands they sell, Schwinn and Cannondale's. Schwinn is the mass market. Cannondale's obviously the really high-end stuff. And then they have a 3rd business, which is ready to assemble furniture. You know, it's sort of like not quite IKEA, but it's sort of like IKEA, you know, particle board type stuff, university stuff maybe. Some of you might have bought some of their products. And so Professor George and I were talking about this earlier. We own this company in our fund. It's maybe not the best quality company. It's really more of a gram value. Is it a value trap? I think ultimately it won't be a value trap, but it certainly feels like it right now. And the reason it may be perceived as a value trap is because the management team, 3 brothers and a good friend, they keep buying things and paying way too much money, and the return on invested capital is inferior to their cost of capital, which is, you know, for anyone theoretical out there, that's not a good thing. Basically, they're making bad investment decisions. And so what I was saying to Professor George earlier is I thought, okay, what's the outside thinking as a value investor? Why would you invest in this company? And I think the main reason is, number one, is that these three brothers plus friend, they're all getting older. And I know they want to make lots of money. And ultimately, I think they're going to sell the company. And there's so much cash sloshing around right now that everyone wants to buy something and fix it up because there's just not a lot of investment opportunities when interest rates are so low. So I think that will eventually happen. You never know when it is going to happen, but I think it definitely will happen. And I think in this case, the brands have value, and Schwinn has value, Cannondale has value. And what will typically happen is eventually they'll get frustrated with the stock not doing anything. And then they'll say, you know what? And people like me keep saying, guys, why aren't you selling this division? And like Giant's trading at twice the multiple that you're trading. Why didn't you sell the bike business to them? It's a crappy business anyway. They'll pay full price for it. So we just keep working at them, sometimes forever. It seems like forever. So anyway.
I'm wondering what your advice would be for people like us for kind of maximizing and making our search process for stocks as efficient as possible, because I know someone like myself, I'm going to be working full time, not necessarily in finance, and I'm only going to have limited hours every week to look into stocks.
Yeah, it's a good question. Well, I mean, you got access to Bloomberg here or Capital IQ, so you can do your screens. The screens don't take long. Hit EQS. And then market cap and throw in ROE and some P and stuff like that. And then what I think you do is you have the list and you just research. The other thing, I mean, maybe this isn't super scientific, is I always look at the Globe and Mail's 52-week low. I mean, that's sort of the deep value guy in me. You know, what names are in there right now? Corby's is in there right now. Morguard, MRC, which is a Ray Sahi. He's a value investor. You know, he owns a lot of real estate. You know, that's a decent company. You know, Dorel continues to be at a 52-week low. Okay, we're not talking about Dorel anymore. And then what you do is, I think one of the most efficient things is once you sort of look quickly at the companies, print out the annual information form and just read those. And just when you got time, just read it, see what the company's about.
So maybe I misunderstood you, but you said that you appreciate firms that have no debt because it provides option value. And what we've sort of learned in class is that for firms, there's an optimal capital structure, and sort of previous financial learning is that like as you increase debt towards the optimal capital structure, firm value improves. So I'm just wondering like why you value that option value so much more than sort of the other things we might have learned about capital structure.
One person said to me, you know, investing is a very personal thing. I can tell you've got a career in investment banking. Look, you're absolutely right. I mean, there is an optimal capital structure having some debt. And I'm not saying debt should be avoided at all costs. I mean, a bank must have debt. It must have leverage. But I just think that companies that have less debt, and in the case of Calian, no debt, just are going to live another day. Like, so if the market gets tough, they can raise debt because they don't have any debt. It's like you got an unencumbered house. You could put on a mortgage if you needed it, right? Now, if you can have some debt, but if you have too much debt and then that earnings doesn't come through and your debt to EBITDA measure, which is 2.5 times, goes to 4.5 times, your equity value is going to go south quickly. So it's your money, not mine.
So I had a question for you concerning assets under management. So Warren Buffett was recently in the news talking about how he likes to manage Todd and Ted's his two portfolio managers' positions at about $13, $15 billion.
Yeah. And
he sees constraints on that, being it more difficult for their assets under management to grow.
Yeah.
In terms of making investment decisions. So you guys are sitting at 13.3. Do you think that that's about your maximum, or how do you see that growing?
Well, the 13.3 isn't just in one asset class. So we have our largest asset class is Canadian equity. And we have probably, if you include our sub-advisory, about $8.5–9 billion there. And in certain mandates, we've closed. So what we do is we say to the portfolio managers, if you think you're reaching your limit, then you can close it. We also do our own sort of academic exercise to find out what percentage we own of the float of the TSX. So I think for now, we're not, for us, it's not an issue in the large cap space. We still think we have some capacity, but in the small, we've closed it.
I have a question a little bit about risk. Like, could you talk a little bit about risk?
Yeah.
Before coming here, I went through like some of the fund performance in your fund, and I found that like, there's a fund like even 20 years, like more than 20 years, but almost like no problem with the crisis in several years. So could you talk about like, do you consider the risk for the company like you talk about, or you consider like risk in economic or other factors as well?
Yeah, risk is there's a lot of variables you can talk about risk. So we'll talk. So the first bucket of risk is just at a company level, an individual security basis, right? So what's the company's risk profile, i.e. debt, operating leverage, financial leverage?
But outside of that, do you consider other risks, like not in a company, but outside as well, like the macro?
Yeah, so we're very conscious that there are certain macro factors that could flow through the entire portfolio. Price of interest rates, price of oil. That we have a fairly big commodity exposure. So any of our commodity holdings in energy or in the materials, metallurgical coal, copper, zinc, those are factors. For the financials, the unemployment rate is a huge factor. That is one of the biggest factors. If the unemployment rate goes up, it's bad for banks. If the unemployment rate goes down, it's great for banks.
Okay, I have a second question about the Canadian small cap.
Yep.
I'm not sure I read it correctly, but I found that like performance for small Canadian equity is not as good as other funds. So could you explain a little bit more about it, or like are there a lot of value investors in the market and they focus on like small cap and that's why like no one make money?
Well, I'm going to give you my general answer always on performance. It's start date and end date sensitive. So in fact, our small cap fund last year outperformed our large cap fund last year. As you extend the period of time frames and change those start and end dates, it can be quite different. We actually believe that it's good to have a little bit of small cap as a diversifier for the large cap. But anyway, you can see the numbers we've got all our numbers on our website. In theory, the small cap company should be a little more volatile, but should have a higher expected return because it's easier for a small cap company to grow than it is for a large cap company. Although, this is one that's quite different. We just had all the Canadian banks report, or almost all of them, I think, except TD. And the Canadian banks are growing, or TD just actually reported today, they're growing earnings like, it's crazy. It's like high single digits, low double digits. So, TD, I think, was 17% earnings growth today. It was just, I was shaking my head. So it really depends on the cycle. Small cap companies perform better when times are good and there's generally strong economic conditions. When times get bad, you want to be in a larger company because they have more options to cut costs than a small company does.
Regarding companies with moats, we see the power. Some companies' moats are eroding over time.
Yeah.
As we see the power of moving towards the consumer.
Yeah.
For example, Gillette, which used to make a lot of money by having prime shelf space in a lot of retailers.
Yeah.
Now you see companies like Harry's and Dollar Shave Club cutting into that market share.
Yes.
Because they're offering premium value to the end consumer without the margins the retailer has to go through. So,
fair point.
could you talk about how you look at companies and see whether their mode is sustainable in this changing time?
Yeah, it's so I actually have these conversations quite a bit with. There's not too many consumer package companies in Canada. They're more in the U.S., like especially Harry's and Procter and Gamble and all that sort of stuff. I agree with you. The business model is changing for some of these companies, and it seems like smaller companies have more tools at their disposal to create direct connections with consumers, right? Whether it's selling razor blades or whether it's selling nutritional bars or even craft beer. So yeah, you have to be aware of that. And in fact, Stephen Mitchell, who's our global manager, was just down at the CAGNY conference in New York, which is the Consumer Goods Package Conference. And he was remarking that a lot of companies are frankly struggling to traditional companies like a Kellogg's that are trying to grow their earnings because they're missing out on some of these opportunities, or they've just frankly given up on categories like cereal and things like that. So you have to be mindful of the trends that are happening in the industry and frankly, how much you're willing to pay for it, right? I.e., are you going to pay 20 times for a company that's got maybe 1% earnings growth and is struggling with some of these factors, So you got to be very, very careful that you understand. The problem is, though, with some of the larger companies, like we own Nestle, and Nestle has Nespresso, which, as you know, is a fabulous model. But Nestle also has some companies that are divisions that aren't quite as good. So as companies get larger, they have to be conscious that they're applying good portfolio management and getting rid of those companies before they become maybe a little more, not obsolete, but just are less relevant, so to speak. So yeah, you've got to watch that for sure.
Like you talk about a little bit more about like jump into Korean finance and then into buy side. So could you elaborate a little bit?
Sorry, but buy side, and what was the other side?
From jump into finance elsewhere and then like moving around and get into buy side after that.
Oh, yeah. Well, sure. Really quickly. I mean, I think first and foremost, if you want to get into the buy side, you don't necessarily have to do it from the get-go. I believe, honestly, that working in a business is very, very valuable. Working in a business and understanding how a business works, I think can make you a better analyst because you can see actually what happens in big companies. So, my career, I worked in consulting and then I worked for Bell Canada, BCE, Bell Alliant. So I was working on the other side and trying to, and seeing how things work in a big company and how they have to deal with cutting costs. And I was really fortunate to work with a fabulous management team there. Stephen Wetmore is, and Mahez Wickramasinghe are two of my bosses at Bell Alliant, and I learned so much from them. And I think that makes me a better investor. Because then you can, when you're talking to management, you can question them and question them credibly and say, well, do you really think you can do this? Or, because you've got a bit more experience, right? So don't, like I took a very bizarre way to get into this role, but I love it. And I'm very, very happy that I'm doing it professionally. And personally, obviously, I've been doing it for much longer. But you don't worry, you can get in, but get really good experience. And the only other career advice I said to the folks earlier is, if you're in your MBA and you're coming out, don't job hop. Okay. If you go into a company, they woo you with a big bonus and all that sort of stuff. And then after you go, I don't really like that. Stick with the company. Assume you're going to, like an investment. You assume you're going to own this investment for a while. You're going to be with the company for a while. When we look at resumes, I find it way more interesting when I see someone who's worked in a company, had progression within that company for a few years. If you're just job hopping, then it shows you got no tenacity, no grit. And that's really what you want to see.
What is the most important thing you learned in life and investing over the last 20 years?
Oh yeah, that's right. This is such a big question. Well, I think in investing, you have to be incredibly humble because this is a humbling business. And all of us think we're so smart. You're going to a great business school and stuff like that. And I'm telling you, when you make an investment in a company and it drops half in value, and it's going to happen every once in a while, we all make mistakes. It's painful. So I think, in investing, you got to be humble. The other thing I would say is you got to be very patient in this business. If you're a day trader and you buy and sell stuff every week, this is not the business for you. Investing is not a spectator sport. It's a thing that lasts decades. And so, as I told you earlier, my first investment when I was about 12, and I kept it for, 20 years, right? And let it compound. So I think as an investor, if nothing else, you're making few decisions, but very good decisions. If you're just buying and selling stuff just because you're thinking this is going to go up and this is going to go down, that's speculation. That's not investing. And so make sure you understand that difference.